guys, so back sometime in January, 10 banks agreed to pay $8.5 billion to settle claims of abusive foreclosure practices with the Federal Reserve and the OCC. Do you remember that? Probably not. I mean, if that was the only bank lawsuit by the government then, yeah, maybe you would. I don't know. It's not even really the point. Anyways,
the Federal Reserve and the OCC said at that time that they're gonna give $3.3 billion in cash payments to duped homeowners who were foreclosed on in 09 and 010, and the settlement also provided $5.2 billion in borrower assistance that could include mortgage modifications.
Okay, Frank, that's how we get to the $8.5 billion. We take the $3.3 billion in cash payments plus the $5.2 billion in borrower's assistance, and that equals $8.5 billion of the $8.5 billion settlement. Well, I gotta tell you, that sounds pretty good to me, but that was way back in December and January. So why don't we take a look at their progress and see what they've done? What has the OCC and the Federal Reserve done with all that money they got from all those big, nasty banks? Now, I'm sure you see where this whole thing is going, but remember, we just outlined what they were supposed to do.
Well, according to Congresswoman Carolyn Maloney, the Federal Reserve has paid out more than $1.5 billion to consultants. That's right, consultants, but not any homeowners. And that's right now.
Okay, but Frank, back in January, $3.3 billion in cash payments, $5.2 billion in assistance to get that $8.5 billion. Where in the heck is there any room for consultants in here? Oh, and $1.5 billion to consultants? How does this even make sense to anybody? Why aren't people up in arms? Guys, $1.5 billion in consultants on how they divvy up the rest? That's like me getting paid $4 to figure out how to hand out $6 other dollars.
Now, in the Federal Reserve's defense, Ben Bernanke, in his testimony before the House Financial Services Committee yesterday, admitted that the Fed takes responsibility for the slow process, but they have now streamlined the process that will completely bypass the consultants, and they'll deal directly with the borrowers. And just $1.5 billion later, how did they even get in there?
I don't know what to say about that. But anyways, let's go on with Ben Bernanke's testimony and what he had to say about the QRM standard. He said it should be no broader than the QM rule, as we reported to you last week.
QM being qualified mortgage. And he also said that the QM rule should not be so constraining. And we agree.
Now the QM and the QRM rule, in case you don't know, this affects you, realtors, borrowers, sellers, really everybody in real estate. And here's why we bring this up. Based on the QM rule, right now only 53% of loans being written today would qualify as a qualified mortgage.
53%! I mean, can you imagine that? And, according to CoreLogic, even less would qualify under the QRM rule.
Which means a more restrictive QRM rule would not be good. Chop your production in half. Where does that leave you? Where does that leave all of us? That's when you consider that some lenders would be very reluctant to fund any loans that don't meet these parameters.
Which means fewer loans and loan options for your clients out there, if you're an industry professional, or for you, if you're a buyer or a seller, which is exactly what we don't need right now.
Okay, so according to Bernanke, we've got to make these rules the same, and let's go on the easier side of it, but honestly, at the end of the day, can't we just reconsider this whole thing? Because it's got mess written all over it, and I tell you this for a reason, and I want to share it with you right now.
According to a report from Interthinks a couple of days ago, fraud is more prevalent today than it was back in 2009? Really? Now, if that's the case, and we wonder, but if it is the case, then one can only deduce that all the actions, including the QM and the QRM and the legislative changes and the underwriting changes and the policy changes, has led to lenders being more slimy?
Okay, but if that's the case, then the cure is just not more of the same, but let's go back to when lenders were less fraudulent. Before all these rule changes, I mean, right?
Well, you know, truth be told, the ones that we're concerned about, it's not the banks, but it's that $1.5 billion in consultant fees, man, and the policies set forth by those that push that little snafu right under the old rug there is much more egregious than what the banks and lenders and servicers' actions have been over the past few years.
My only thing I want to say, Frank, is legislate the legislators, regulate the regulators, and we're all going to be a heck of a lot better off because we've got a huge misallocation of $1.5 billion. It's not even on the radar for anybody to talk about right now.
I know. Stuff just kind of gets slipped right under the old rug there. Yeah. Well, you guys have a great day. Check out all the other articles here on National Mortgage News. They're a great site, and we'll see you again soon here on the National Real Estate Post.
Bye, guys. Thank you.